Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, September the 22nd. Wanted to take just a brief moment to discuss a down week in markets last week as the S&P 500 finished the week down 4.77%. The mid-cap index finished down 4.1%, and the small-cap index is measured by the S&P 600 did better, even on a negative number, down 3.5%. And this was all about, last week, we talked about it last week, this was all about the inflationary data that we got. And all eyes were going to be this week on Fed Chair Powell's commentary coming out of their September meeting, which started Tuesday and ended yesterday at 2 o'clock. Now, the market knew going into that meeting yesterday that the Federal Reserve Bank was going to raise interest rates yesterday when they came out by 75 basis points. And that is, in fact, what they did. And the interesting thing is you saw the market before the interest rate announcement was positive a little bit. And I wanted to speak why the market was a little bit positive yesterday and heading into that commentary. What the market was anticipating and hoping that the Fed chair would say is that they were going to raise rates to 75, maybe another raise in a couple of months, and then a pause to see where monetary policy was and the impact that it was having on inflation, and to see if inflation is coming down. And when the Fed chair got up and started speaking yesterday, he really kind of put that to bed for at least right now, and said that they're going to keep raising rates until they see inflation is at their 2% target mark, and that they see the inflationary or the run rate for, or the break-even rate or their terminal rate, as high as 4.6% by the end of this year. And the market was anticipating maybe 4.2% by the end of this year, maybe 4.4 worst case scenario. And so you have the Fed chair being even more hawkish in his commentary, while in reality, when you peel back and look at what's really causing the inflationary numbers, you can see a lot of correction happening there. Rents are falling apart. The housing market is quickly coming down. Home prices are coming down. Houses are staying on the market longer. Inventories are starting to rise. So you're starting to see the impact. And as we discussed last week, monetary policy takes anywhere between 6 and 18 months to really fully be digested into the market. And so we've essentially gone from 0 at the beginning of this year, and we're now at 3%. At the terminal rate right now at 3%. So we've had a very aggressive move here. And the concern and the objective of the Fed was always that they were going to orchestrate a soft landing where they wouldn't cause any pain to unemployment or cause a recession. And yesterday they said they want to see employment come up, the unemployment rate come up to about 4.5% is where they would feel comfortable. And so they said essentially that we will feel a little bit of pain as we fight inflation, and that it was going to be painful for a little bit to get inflation under control. And then you saw the market digest that comment yesterday, and then you saw the markets finish lower. And today we're trouting around the NASDAQ as rates continue to skyrocket. The 2-year before the Fed chair spoke yesterday was hovering right around 4%. It's jumped all the way up to 4.1%. And as those rates and the short rates continue to increase, you're going to continue to see the pressure on the NASDAQ. So while you have the Dow hovering maybe 20 basis points down as we're speaking currently, you see the NASDAQ down a full percent. Well, as those interest rates continue to keep rising, you're going to see the impact on the technology stocks and the high PE stocks, and that's what comprises the NASDAQ. So if you are positioned in a growth position in your portfolio and it's overweighted growth, you may start, as the rates continue to increase, you'll see more pressure on the selling of growth. But eventually, the rates will stop rising. The market will look past that, and we will start recovering from the slowdown that we're seeing happening currently. We will come out of it. There will be brighter days ahead, and the market is going to anticipate that before it actually happens. So positioning yourself on how to capture the upside is incredibly important here. You have the opportunity now, especially if you're a long-term investor, to kind of get back into the marketplace at a very discounted rate. And we have the opportunity to move higher from here. We often talk about our money flow analysis. That's the technical analysis that we use at RiverPlace to study the technical side of the market. And our technical analysis and our money flows are incredibly bullish right now. It's telling us that we're set up for a nice rally to the upside, potentially. We just need some type of catalyst to get us there. And whenever everyone is on one side of one trade or the other, I would encourage you to take the other side of that trade. And as sentiment just becomes so overwhelmingly negative, use that as an opportunity to enter into the market as a buying opportunity. Take something that somebody's willing to sell you that they bought for cheaper than what they bought it for. You would do that. That's a great deal. Well, that's what the equity market is doing. You can get in now cheaper than you could a year ago. So as always, if you have questions about what's happening in the markets, the impact of the Fed chair's comments moving forward for here to the year end, feel free to give us a call. We're easy to talk to. We'd be happy to talk to you about it. You can reach us at 904-346-3460. Or as always, check us out online at www.riverplacecapital.com. Have a wonderful rest of your week, everyone. Thank you so much.